been one of the most interesting topics nowadays. And one of the most influential books on investing is about The Intelligent Investor, written by Benjamin Graham. It was established almost a century ago, but still relevant today. Warren Buffett, arguably the most successful and respected investor, has been quoted saying that The Intelligent Investor is by far the best book on investing ever written. In his preface to the 4th edition of the book, he told the reader that successful investing does not require stratospheric IQ psychic powers or insider information. Instead, successful investing requires two things. First, a sound intellectual framework for making decisions which the intelligent investor provides. Second, you must have the discipline to keep your emotions from corroding your ability to make wise decisions, and this requires self-control and self-awareness. When talking about the intellectual framework and emotions on investing, we keep hearing people saying they want to invest, but they base their decision based on emotions and solely response to the market reaction. Then it means some, if not most of them, fail to understand whether their activities reflect investing or speculating. Before we enter into the discourse about investment itself, let us see the main difference between investment and speculation.
The Intelligent Investor by Benjamin Graham. Hello, my name is Ariela Oktafira and I'm one of MBA students in IPMI International Business School. And today I want to give a review about The Intelligent Investor by Benjamin Graham. I want to review about investment. So, what investment is? Investment is an asset or item acquired with the goal of generating income or appreciation of value. What are investors? Investor is anyone who buys or sells securities, stocks, or bonds in the market. Investors are independent things. They use a dependable system for decision making. The history of investor begins a while ago in Wall Street, where everyone who buys or sells securities already become an investor, regardless of what they purchase, or what purpose, or even at what price. The Intelligent Investor books tell us about how to become a smart investor, how to smart investment, and with a long term and avoid high risk in capital market because of price fluctuation. The investor principle has three things. 1. The first is comprehensive analysis of overall factors that may affect the investment, the share price, and the company before investing on the shares. The shares not just a mere object you trade. It's a piece of ownership in business. Therefore, the share has a fundamental value that is often not share price. Understand the business and you understand the fundamental value. Second, so investor can avoid a significant losses by not buying the shares at a price higher than its intrinsic value. To become an investor, you must pay attention to the price at which you buy share. The more you pay for a share, the lower your return. Third, reasonable return without imposing preliminary target return. According to Benjamin Graham, without following three principles, you must be a speculative investor. Long-term investment. Investing well over the long term does not require the incredible intelligence or in-depth insight. Instead, it requires two things. 1. First, a rational framework for making decisions. Second, preventing your emotion and others people's emotion from overriding your framework. With these two elements, and without extensive trading experience, you can do better than more financially educated people who doesn't have a disciplined and lack patience and of course emotional control.
Since you have listened about the description on investment, by now I believe you understand at least about investment activities. But now, it would be more helpful to know what activities which may look similar to investing but don't reflect investment itself. As a wise man said, it is easier to define what you are not rather than what you are. Let us listen about what constitutes a speculation.
Hey guys, let us review the speculation aspect from The Intelligent Investor by Benjamin Graham. So, speculation is a fascinating game, and if you're willing to risk it, you should put a little portion of money that is spread from your capital fund for the purpose. Do not just add money for discount when you feel that the market is going up and look profitable. Moreover, you should not combine speculative and investment activities in the same account. There are several methods for investors and speculators to achieve better than average result. First is trading in the market. This usually means that you purchase the stock when the market is rising and selling them when it is declining. Second, short-term selectivity. It means purchasing stocks when it is expected to have increased earnings later on than the development will be anticipated. And the third is the long-term selectivity. You can analyze that there is a tremendous growth in the past record that will continue in the future. However, it's also possible that investors may pick companies that do not promise good results yet, but it is expected will gain higher earnings later. So, if we separate the distinction between investment and speculation, according to the time horizon, speculation is considered as short term, like you hold the asset from 1 day up to 1 year. And speculation is also considered as a high-risk investment. For the source of income itself, speculation depends on the change in market price. And for the stability of income, speculation is considered as uncertain. And for the use of fund itself, speculation use own funds and also borrowed funds. And speculation is ownership type of contracts. And the last one, according to the psychological attitude of the participants, speculation is considered to be aggressive and daring. So, if you think of intelligent investing, the other hand, also there is intelligent speculating. Speculating may seem unintelligent based on several factors. First, speculating when you think you are doing an investment. And the second one, lack of proper knowledge and skills. And the third one, you risk more money in speculation more than you can afford to lose. In my closing statement, in most times, an investor should accept the speculative factor and maintain it in minimum limit, as they also should be prepared psychologically and financially for any adverse effect that may arise from a short and long-term period. To close my statement, this is a rare footage explaining the danger of speculation from Benjamin Graham itself.
But it has to be found in investor psychology. You can have an extraordinary difference in the price level merely because not only speculators but investors themselves are looking at the situation through rose-colored glasses rather than dark blue glasses. It may well be true that the underlying psychology of the American people has not changed so much, and that what the American people have been waiting for many years has been an excuse for going back to the speculative attitude which used to characterize them from time to time. If history counts for anything, that the stock market is much more likely than not to advance to a point where a real danger.
So guys, what the video talks about is the danger of speculation concerning about the stock market that does not rely on mathematics, but it depends on the psychology of the investor. The difference in price is relying on the speculators and investors themselves. They tend to be more optimistic, as Graham defined as the rose-colored glass rather than the dark blue glass, defined as prejudice and stereotype people. American people will find an excuse to go back to the speculative attitude, and this might become harmful and a real danger.
I hope by now you can differentiate between investment and speculation. Now, let us dig deeper about investment activities and decide whether you are a defensive investor or enterprising one.
Now, we are talking about the type of investor, which is defensive investor. Benjamin Graham has been helping us to understand about this type of investors in a very comprehensive way. Personally, I also really like how he make it and elaborated in a very simple way so it can easily be understood. How do you know that you are a type of defensive investor or being a defensive investor? The further descriptions and explanations about this type of investor are captured in the chapter 4, 5, and 14 of this book. Let's check it out! What is the definitions of defensive investor? According to Graham, the defensive investor is an investor who is unable or unwilling to put in the time required to be an enterprising investor. A defensive investor focuses on finding conservative investment that required little effort in a portfolio management. Now that you know about the defensive investor and its descriptions, then we can figure out what is the characteristics of being defensive investor. Here they are. 1. They choose an options to use conservative approach. A defensive investor is willing to earn an average return. 2. The defensive investor creates a portfolio that runs on autopilot. 3. It also requires minimal effort and time. 4. This investor selects a balance for his or her portfolio. Say 50-50, with half of the portfolio invested in stocks and the other half of portfolio invested in bonds or cash. As the market fluctuates over time, the defensive investor will periodically engage in portfolio rebalancing to keep the money value of the portfolio at the desired 50% stocks, 50% bond ratio. Chapter 14, about the stock selections for the defensive investor. Graham provides a set of standards by which a defensive investor can obtain quality and quantity. He outlines a set of 7 rules or criteria for stock selections that the defensive investor should follow. 1. Adequate size. Defensive investor should only invest in large companies, those with at least 2 billion in total market value. 2. Financial conditions. The company's current asset should be at least twice its current liabilities. Because with these cushions of working capital, the company should be able to survive hard financial times. 3. Earning stability. This means that the company common stock should have positive earnings in each of the past 10 years. 4. Dividend record. The defensive investor should look for companies that have paid a dividend for at least 20 years in a row. 5. Earning growth. The defensive investor should only invest in companies with a 33% cumulative growth over a decade. This is a pretty low hurdle. It's a little less than a 3% average annual increase. Quick note: the commentary on chapter 14 points out that a cumulative growth of at least 50% or a 4% average annual rise narrows the choices of the company significantly. And a cumulative growth of 100% or 7% annual growth narrows the choices even further. 4. Moderate price to earning ratio. The defensive investor should limit himself or herself to stock with a current price that is less than 50 times average earnings over the past 3 years. 7. Moderate price to book ratio. The ratio of price to asset or price to book value ratio should be no more than 1.5 or less. The popular view is that the investor should tailor the amount of risk they are willing to take to their risk tolerance. But Graham has a different outlook. For him, the amount one should accept depends on the amount of intelligent effort the investor is able and willing to expend. That's a brief information about defensive investor.
Hi everyone, my name is Gita and today I'll be talking about the enterprising investor. What is an enterprising investor? Let's take a look. The enterprising investor is an active investor, while the defensive investor, the enterprising investor's goal is to achieve above average or even extraordinary returns. Thus, rather than maintaining a balance of assets, like the defensive investor, the enterprising investor continually researches the market and stock prices and actively manages a dynamic portfolio. And their portfolio actually consists of stock, bond, and mutual funds. And its aim is to achieve the maximum results. Graham provides a list of 5 rules or criteria of stock selection for the enterprising investor, which are: first is the financial condition. The enterprising investor should select companies with current assets of at least 1.5 times of its current liabilities. Second is the earning stability. Select companies with no deficit in the 5-year. Or put another state, the company should have a positive earnings for the past 5 years. The third one that we're looking into is the dividend report. The company should pay some current dividend at least. The fourth one is the earning growth. Select companies with current earnings that are greater than the company's earnings sometimes in the past. Means that their current one has to be greater than their past. You might compare the company's current earning to its constant earning. Make it like 10, 15, 20 years from now and before. And then let's take a look at the comparison and see how are they doing now. The fifth one is the price. The stock price should be less than 120% of the company's net tangible assets. Now, we need to compare between the defensive investor and the enterprising investor. We can actually see as an investor, you might know that the above investing rules for the enterprising investor are much less extreme and much less strict than the outline for the defensive. Let's quickly summarize the difference between the enterprising investor and the defensive investor. First, the main difference between an enterprising investor and a defensive investor is that the enterprising investor dedicates lots of time and efforts to the science of investing. The defensive investor, on the other hand, has his or her portfolio on autopilot. The enterprising investor continuously researches the market and invests on the most opportune time. The defensive investor pays into her or his portfolios consistently, which is called cost averaging. Finally, the enterprising investor trades regularly, while the defensive investor rebalances his or her portfolio probably once or twice a year. This begs the question, what kind of investor do you actually want to be?
Maybe by now you have a glimpse of your decision on what kind of investor you want to become, the defensive one or the enterprising one. But we have not finished yet. Now, let us discuss about the most important lesson from the intelligent investor, the margin of safety. Graham says that the margin of safety is the central concept of investment. One of its benefits is to understand when you should buy or sell the stocks at the right moment. Without further ado, let us dig in about the margin of safety in investment.
Allow me to introduce myself. My name is Yudhian Azhar and I'm in charge with margin of safety part. Margin of safety is mentioned in the Intelligent Investor book in chapter 20. In order to make this presentation more complete and can be visualized by the audience, I also add several materials regarding the intrinsic value. Before we start up, I would like to give some of my outlines regarding this book review. First, we will talk about the definition of intrinsic value according to Benjamin Graham. Secondly, we will do a hands-on project of how Benjamin Graham is calculating the intrinsic value using Microsoft Excel. Furthermore, we will discuss about what is margin of safety and how Benjamin Graham practiced margin of safety on picking up the right time to purchase a stock. Okay, now we will talk about the formula of the intrinsic value based on the Benjamin Graham and the practice of margin of safety in our investment. First, we will talk about the intrinsic value formula, and according to Benjamin Graham, intrinsic value is equal to EPS multiplied by open bracket 8.5 plus 2G close bracket and multiply by 4.4 divided by Y. And each of these variable I will discuss it to be more specific. And EPS is the current amount of the company's specific year of earning per share, and 8.5 the constant variable of US stock market growth in the specific year based on Benjamin Graham, and G represents growth of the company that will be identified, and 2 is represent Benjamin Graham expectation of the company's future growth. 4.4 represents the risk-free rate of investment in the US around 1960 with tenor of 10 years, while Y represents AAA corporate bonds yield in the US around 1960 tenor of 10 years. Question: how Benjamin Graham's formula of the intrinsic value to be applied in Indonesia stock market? Well, there are several things as an investor, especially in Indonesia stock market, need to be considered before applying the intrinsic value formula of Benjamin Graham towards picking the right stock in our portfolio. Therefore, several adjustments needed to be applied in the previous formula, such as: first is the constant variable of 8.5. In order to perform conservatism theory, we need to lower down the constant variable into 7. Based on an article that I have researched, as part of our mitigation of potential overvalue and also as the method to practice the margin of safety. Secondly is the growth variable. As we know, US is an emerging country, meanwhile Indonesia is categorized as developing country. Therefore, we cannot generalize the growth rate of US company with Indonesia companies with the same variable. Hence, we change the 2G become only G. Okay. The third one is risk-free rate of investment. The risk-free rate of investment variable needs to be updated with Indonesia government obligation yield with tenor of 10 years because 4.4 value represented the economic condition in the US back to 1960. So this is our modified Benjamin Graham formula to determine the intrinsic value. Okay, as you can see, this is still like the first one. Intrinsic value equal to EPS multiplied by open bracket 7 plus G close bracket multiplied by 6.57 and divided by Y. So the changes only on the 7, the G, and this 6.57 and Y. Okay. Now start with the 7 is the adjusted of the constant variable of Benjamin Graham. This is our conservative mode. So previously he stated around 8.5 and then we changed it into 7. And now the G, we take out the 2, the 2, and then we only consider the G. We only consider the G, the normal growth of the Indonesian company, and then the 6.57 is the risk-free rate in Indonesia corporate bonds yield, tenor of 10 years in 2021. As you can see in the source. Okay, this is the source that we have taken from the Indonesia bonds pricing agency. That you can see that you can search it on your search engine. Okay, this is our base, yeah. Okay, and now about the Y is represent the AAA corporate bonds yield in Indonesia, tenor of 10 years in 2021. Okay, this is also the AAA rate of corporate bonds in Indonesia. We have taken it also from the IBPA, okay, Indonesia Bonds Pricing Agency. So this is around 7.75% in 2021. Now we will perform the calculation using the case study of the gudang garam, ya. Okay. Now the earning per share for the third quarter for the year ended 2021 of gudang garam is around 3,000.1. Okay, you can take a look at here. I've taken it from the stockbit.com. Okay, this one, and then the constant is 7, as we mentioned before in this part, and the growth rate represents the CAGR, okay, compounded annual growth rate, and then the government bonds is 10 years risk free is 6.7, as we seen before, this one. Okay, and the corporate bond AAA tenor of 10 years is 7.75. Okay, this one, yeah. And now to make sure this is the 10, as the Benjamin Graham talk about the 10 years, and then we need also to have a look on the EPS on 2011 until the EPS per 2021. Okay, in 2011 the EPS is around 2500. Okay, around 2500, and then in 2021 is 3000.1. You can see in this picture, yeah. This is the 2011. Okay, this is in the 2021 third quarter. Okay, and now this is the calculation of CAGR, this one. Okay, so this is the formula is linked from this one. And now the intrinsic value calculation, as we use this according to Benjamin Graham, is around 57,000.5. Okay, and the current price, as we have taken from the latest one in the January 6, 2021, is around 30,900. Okay, now the margin of safety is around the 45.38%. So this is our margin of safety. You can see in this calculation that intrinsic value is still higher than the current price. Okay, so the difference is around 45 and 38%. Okay, and normally if I follow the instruction from the Warren Buffett usually make a calculation around safety buffer around 50 until 70% below the intrinsic value. So this is his favorite safety buffer. And now I'm going to show you the practice of the margin of safety using the this simple chart here. So Benjamin Graham in his book, he metaphors the market like he named it like Mr. Market. Okay, so this is the situation. Okay, this is the red zone, and then this is the intrinsic value. Okay, and now this is the margin of safety, the yellow highlighted, yeah, margin of safety, and the green one, the green area, is the right time for us to purchase the stock. Okay, as we mentioned before, is around 50 until 70%. Okay, just let's say this 45 is around, let's make it like 50%, yeah, this one. So this is the right time for you to purchase the stock in this green area. So this is how the Benjamin Graham implemented that the margin of safety in his portfolio. Okay, so this is the safety buffer that we have talked about before, and then the conclusion of this explanation of this part regarding the margin of safety. This is according to Benjamin Graham. The function of the margin of safety is, in essence, that of rendering unnecessary and accurate estimate of the future.
As you have listened and watched about some of the most important takeaways from the book, I hope it means that you have learned about Benjamin Graham's timeless investment principles. Among others, 1. Knowing what kind of investor you are, and 2. Always invest in margin of safety. You should also need to expect not only profit but also volatility on your investment. The risk is always going to be there. As Graham said, successful investing is about managing risk, not about avoiding it. As you have watched our book review, now I will let you decide which investor do you want to become, the defensive investor or the enterprising investor. But always assess your own margin of safety. Thank you.